Hello guys, so we are moving on to CAPM approach. The last class we discussed about three methods to determine cost of equity. We mentioned dividend valuation method, CAPM approach, and Modigliani and Miller's approach. These were the three methods, and we're able to explain dividend valuation method. But today we are moving on to CAPM approach, and we're going to solve questions. If you can remember clearly, the last time I said that dividend valuation method, it determines cost of equity based on the amount of dividend paid, right? And we said the formula is calculated as D over market value of equity. It must be x div. That is if there is no growth. But if we have growth, it's definitely going to be D over D brackets 1 plus G, which is the growth, then market value of equity, x div plus G. And I also mentioned that the G, the growth, can be determined in two ways, right? Either the historical method or the Gordon's growth model. Using the historical method, is going to be n growth, the newest dividend over oldest dividend minus 1. All right, but if it's going to be through the Gordon's growth model, then it's going to be this: G is equal to R times B, where the R is return on investment or accounting rate of return, ROI. And if you are not given, you can also calculate it to be PAT over opening net assets. And explain to you that net assets simply means the shareholders fund, which is the total asset minus both current and long-term liabilities. That is the same thing as net asset, but we are using the whole thing. And PAT is profit after tax, and it's simple because here it says return on investment. So this is the return, profit after tax. It is on investment, which is the shareholders fund. Simple, right? And B is called the retention rate. Is the retention rate, which can be calculated as EPS minus DPS over EPS. I hope you can see this. Yes, that is the earnings per share minus dividend per share over earnings per share, or PAT, profit after tax, minus DPS, or minus dividend minus dividend div over PAT. Can you see that? It just makes sense to say after we've ascertained profit for a particular year, profit after tax, the out of that profit after tax, we pay out dividend to our shareholders, right? So what do we have left? Retained earnings. And that's why we can also have the formula to also be or retained earnings over profit after tax. Can you see that? Let me write it here. Or retained, as a G, it also retained earnings over profit after tax. Can you see that now? It all makes sense. It could also be net income minus dividend over net income. It's saying the same thing, right? So that is that. But today we are going to CAPM approach, and I explained to you. Let me clean the board. So now we are moving on to CAPM approach. See, this is very important. Hear me clearly when I say this. For every cost of capital question, right, I told you that we have the equity, we have the debt, and we have the WACC, right? So for cost of our capital question in equity, always see it from the investor's point of view. Always see the question from investor's point of view. Same thing as cost of debt. When we get to cost of debt, I'm going to make it clear. Always see it as it, because cost of equity is the minimum required rate of return that is expected from an investment, right? So amount that you're supposed to get if you put your money in the particular capital project or investment. So always see from the point of view of the investor. But when it comes to WACC or WACC, right, you cannot see from the point of view of the company, right? Because the company use both equity and debt, right? So let's move on. Well, all I'm trying to say is that for cost of equity, always see from the investor's point of view, right? So we're going to solve questions for now. So for CAPM, what exactly is the formula? Let me show you. So using CAPM approach, the cost of equity is equal to risk-free rate plus beta equity bracket market returns minus risk-free rate. So this is risk-free rate, which is return on investments without risk, just like the name, risk-free rate. So the returns you get from an investment without risk, which is usually government, treasury bills, and all that, that you'll be given in your question. And this is the risk, right? This is the risk. It's usually systematic risk. Yes. When we got to portfolio theory, I think we're going to talk more about that, right? This is the risk, because see, it makes sense. I told you one of the roles of a financial manager is to also make investment decisions, and for every investment you will ever make, there is a risk attached. So CAPM approach is saying that do not determine the cost of equity by dividend. No, do not. The CAPM approach is saying do not determine the cost of equity through the dividend paid or the amount of dividend paid. No, it's saying, or CAPM approach is saying that determine the cost of equity by considering the risk attached and the returns. So CAPM approach shows the relationship between the returns and risk. Do you understand that? So here is the risk of the market, the risk, beta equity, and there's the market returns, and there's the risk rate. So when we solve question, we're going to understand better. So, and as I've said, here's the cost of minimum required rate of return. That is amount you are going to get. This is the return, right? And this is the risk. So the higher the return, okay, the higher the return, the higher the risk. There is a positive relationship between these. So can you see that? So let's solve question. We have a question on the board already. So we have a question on the board saying Topware PLC has beta of 1.6 if the risk-free rate is 7% and the market risk premium is 6%. You are required to calculate the company's cost of equity. Can you see that now? Calculate the company cost of equity. So looking at these questions, you may ask yourself, which approach will I use? Is it dividend valuation method or CAPM approach or Modigliani and Miller approach? The question will direct the method to you. So looking at this question, we are given information about the risk-free rate, about the beta equity, about premium. So what comes to you is the CAPM approach. And don't forget, I tell you that every time you see an ICAN question, the first thing to do is to go to Yarukayat, which is this. This is the Yarukayat. Calculate the company's cost of equity. So you know you can solve this. So the next question will now be which approach? CAPM approach. So write your formula and let your formula guide you. So cost of equity using CAPM approach is risk-free rate plus beta equity RM minus RF, and the difference between this thing is called premium, right? Market premium or premium. So what is the cost of equity? What is the risk-free rate? The risk-free rate is 7% plus what is the beta equity? 1.6 bracket. What is the premium? 6%, right? Because premium is the difference between this. So the premium is 6%. So if you punch your calculator, you have your answer. Where's my calculator? 6 times 1.6. The answer is 16.6%. Can you see that? Very, very simple. So here's a question. Will I can give you questions like this? No. It won't be this plain and clear. So this is what ICAN is going to do. ICAN is going to put this question. It might actually put it maybe in an investment appraisal question or APV, right? And if we are doing APV, when we get there, you know that you use Q, to discount your present value and all of that. To discount it, you use Q as a discounting factor, right? So as I've said to you, as I've mentioned, that SFM to you will mean speed, meaning you run down to the requirement first, right? The next one is F, facts, gather the information. So you are going to be given a lot of information, different details, information, and all of that. So, but you'll be wise to know the facts or the figures to use, the relevant information to use. So that is fact. And mastery is as a result of consistent practice. So keep practicing questions, keep solving questions. That's how you get better. Let's solve another question. All right, so let's move on to the next example, example 2. So it says the average return currently expected by investors on the stock market is 15%. Can you see that now? 50 expected by investor. So see from investors' point of view. Why the yield on government treasury bills is 6%. So that means 15% is RM and 6% is risk-free rate. So Peak Food PLC has an equity beta of 1.4. That is the risk. Yes. So you are required using capital asset pricing model, calculate the required return on an investor in Peak Food PLC. Can you see that now? So using CAPM. So what is the formula for CAPM? As I said, you want that to the process is go to the requirements first. Then the next thing, which method are you going to use? Write out the formula using CAPM, which is KE. It is risk-free rate plus beta equity RM minus R. Yes. So let's bring out our variables or parameters. So RM. So what is the risk-free rate? The risk-free rate is 6%. Right? So risk-free rate is the treasury bills, government treasury bills, and all that. So what about the beta equity? 1.4. This is 15% minus 6%. So let's punch our calculator. 15 minus 6, 18.6%. Can you see it? Cost of equity is 18.6%. Can you see that now? Good. So let's solve the next question. So let's solve the next question now, example 3. Saying the current risk-free rate is 4%, while the expected market return is 13%. Determine the required rate of return for investment with the following beta values. So we are giving beta values. So for 1, so we want to find the required rate of return, that is KE, of different beta, different risk, right? For number 1, it is, what is the risk-free rate? This is the formula, plus RM minus risk-free rate. So beta plus beta equity, right? So for the first one, 4% plus, what is the beta for the first one? Is 0.8, right? Brackets 13 minus 4%. So whatever the answer is, right? The second one will be KE equal to risk-free rate plus beta equity RM minus risk-free rate. So let's do that again. 4% plus 1, 13 minus 4%. We have an answer for that too. Then the third one, K, risk-free rate, beta equity, Rm minus risk-free rate. Then we have this to be 4% plus 2.2, 13 minus 4%. So let's find the final answers for these values. Zero point 0.8, no, 13 minus 4 times 0.8 plus 4. This is 11.2%. 11.2%. This will be 13 minus 4 plus 4. This is 13%. K, 13%. 13 minus 4 times 2.2 plus 4. This is 23.8%. Can you see that? So these are the answers, but there's something very important that you need to see here, right? As I have explained to you, that CAPM determines the cost of equity based on the risk and the returns, right? So if you look at this now, you will see that the higher the risk, because which one has the highest risk? Highest risk is it, and it has the highest return. Which one has the lowest risk? This has the lowest risk, and it has the lowest return, right? And this one that has just one risk, like just one, can you say that it's the same thing as the market return itself? That the return that is in the market is the same thing. Like it just has one particular thing. And as you can, so that is just to tell you that the higher the risk, the higher the return, which is K. The lower the risk, the lower the return. Do you understand? It's that simple. So the next approach we want to get into right now is M&M approach, Modigliani and Miller's approach. See, I think you can read about that, but basically one of the things they concluded was that there are two market, the perfect market and the imperfect market. And of course, you know and understand that in a perfect market, there's no transaction cost, there's no tax, and some other things like that. So they are saying that in a perfect market, when there's no tax, capital structure is really irrelevant. That is, there is really no much effect between debt or equity. All right, so that's what they're trying to say, right? So whether you raise fund through debt or equity, it doesn't really matter because there's really no difference, right? But in an imperfect market where we have tax, which is in reality there is taxation, is saying that raising capital through debt is better because it leads to increase in the market value of the company. The question is how? The reason for that is because when you raise money through capital, through debt, when you raise money through debt, there is something called interest. When you pay interest, interest is a tax deductible item. When you pay interest, it reduces your taxable profit, and as a result of that, you pay less tax, and that is called tax saving. And because of tax saving, it increases the market value of a particular company, right? Or increase the worth of the shareholders. So that's why what Modigliani Miller is talking about, that is, debt is cheaper, debt is better, and debt leads to increase in the market value of a company. And that is the whole point of strategic financial management in the first place, which involves the identification of various strategies that maximizes the worth of the shareholders or that increase the market value of your company. So with all this English, let's jump right. So I'm not even sure they're going to ask you to explain what this thing is really in ICAN exam, but then I'm just trying to tell you, right? So what are they saying? So they are saying that KEG I think I've explained this before. Keg is not equal to K, and that keg is greater than K. So the question is, what is keg? Keg is actually cost of equity geared. And she's talking about the fact that it's talking about the cost of capital of a company that is financed by both debt and equity. While K is cost of equity ungeared, that is cost of capital of a company that is financed only by equity. That is, there's no debt element. That's what it's saying. And it makes sense because, come on, it's saying here, this involves equity plus debt, right? This is just equity alone. So of course, this will be greater than this. Just saying. So here's the formula. In order to determine your cost of capital, the formula is this: keg. I will see it. Let me make it bolder. Keg is equal to Q plus bracket Q minus KD, value of debt over value of equity, and of course tax. Can you see that? That is tax 1 minus tax percent. So this is the formula. You are required to know the formula. Just know the formula. But here is just the way I can help you to remember the formula, right? And don't forget, there was a way I related this thing to the financial roles, or the roles of a financial manager. And don't forget, there was a way I related this to the roles of financial managers, right? I said there are 3 roles of financial managers, right? The first one is what? Financing role. And the second one is what? Investing role. And the third one is dividend. Oh, there was a, and don't forget, there was a way I connected these things to the rules of financial managers. The first rule is what? In financing decisions. The second rule is what? Investing decisions. The third rule is what? Dividend decisions, right? And I gave it an acronym: FID, FID, FID. And I said dividend decision relates to dividend valuation method that considers the dividend amount of dividend paid to determine the cost of equity, right? CAPM relates to investment decisions which consider risk and returns, and financing decisions relates to this guy that's saying that debt, or raising money through debt financing and all of that, has a significant effect in the market value of a company. So that is that. So for me to help you remember this thing easily, I told you that, you know, and this is as well similar to work. This particular method is similar to work. And work, I told you, work is saying both equity, right, and debt. And the formula for work is this. Don't worry, just know the formula. I'm just trying to say some other things that might also help, but the point is just know the formula, and it's simple. I just want to say some other details that might actually be of help. So work, he considers both equity and debt, right? And please don't forget, for work and for keg, try to always see questions from the point of view of the company, right? Questions usually come from the point of view of the company, because it's companies that uses it's because it's only a company that can use both equity and debt, right? So see from the point of view of the company. So equity and debt, right? And the formula is, what is it called again? Work equal to cost of equity times E over E plus D plus cost of debt times E plus D. Can you see that now? So this is equity and this is debt. Can you see that now? So this is just by the way, right? So now I want you to remember this clearly. A way to remember this is KEG has a debt element, right? Both equity and debt, right? So, and this is the formula for it. So, and Q is just the cost of capital of a company that is financed by equity loan. So this is equity, and everything here is related to debt, and we have the plus here, plus E plus D. Do you understand? That's Q and debt. So, and for this component here, this component that relates to debt. So now we want to know, because this guy Keg has both equity and debt, right? So, and this is full equity and this is full debt. So we want to know the difference in these two. That gives us this. Makes sense, right? So Q minus KD, and of course this, and don't forget everything here relates to debt. So but we want to know the difference between this and this. So Q minus KD, then the value of debt over value of equity. Then of course debt, you remove tax, right? Simple. So let's have a question. But the point is just that everything I've been saying, I've just been trying to say additional stuff, right? Just to make you better understand. Well, the point is just that know this formula, and it's simple to know. How do you know it, or how will you be able to memorize it? When you solve questions regularly, and that is where mastery comes in. Continuous practice. All right, let's solve another question. Come on, are you ready to solve questions using Modigliani and Miller's approach? Let's get started. So here's a question saying, Sunrise Dairy PLC is a privately owned company that plans to raise funds entirely through ordinary shares and seek to estimate its costs of equity. Okay, the company's closest listed company is Fresh Milk PLC, which operates in the same industry. This is a proxy company, right? A proxy company, because Sunrise Dairy PLC is not listed in the stock exchange market, right? Stuff like that. So we have information here given here: market value of debt 600 million, market value of equity 400 million, all of that. Yeah, so we have all this information for a proxy company. It's another competitor company that does the same thing. It's called proxy company. You are doing the same thing, you are in a similar industry, but you have your market value, you are being traded. But Sunrise Dairy PLC, it's non-listed, or it's a privately owned company, right? So, and we don't have information regarding the market, the trading market value, the beta equity. We don't have any information about the company. So let's solve question. So the first thing I will say, go to the requirement. So the requirement is calculate the unjet cost of equity for Sunrise Dairy PLC. So looking at this thing now, we are seeing jet cost, we are seeing market value of equity and all of that. So what comes to mind? Could this be dividend valuation method? No. Could this be CAPM approach? No. So it's going to be WAC. It's going to be KEG. WAC or KEG, actually. But we are talking about KEG here. We are talking about Modigliani and Miller's here. Sorry. Modigliani and Miller's here. So using M&M approach, first thing, as I always say, write out your formula. Q plus bracket Q minus KD VD over VE, of course, post tax. So what is the required? So required says calculate the unjet cost of equity. So we are looking for this guy, right? So let's impute our variables or our parameters into the equation. So because we have KEG is 16%, we have KD is 8%, we have value of the 600 million, we have value of equity 400 million, we have tax to be 30%. So let's input our value. So KEG is 16%, Q we don't know, plus Q we don't know, minus, oh, my writing is not small. Please let me know in the comment section if my writing is small so I can do better. KD is 8%, value of debt is 600, value of equity is 400, and of course 1 minus what is the tax rate? 0.30 is 30%, right? So 60% is equal to Q plus bracket Q minus 8%. Let's solve this first. Where's my calculator? So let's solve this first. This is 1, everything here is 1.05. So let's open the bracket, right? 60% is equal to Q plus 1.05 Q minus times 8. This is 8.4%, right? So let's collect like times. This is now mathematics now, right? So let this one come here. So it's going to be let's do this one first. 2.05 Q is equal to, when this one comes here, 16 plus 8.4 plus 16, 24.4%. So Q is equal to this one divided by 2.05 equal to 11.90%. That's the answer. Can you see it's very simple? So, and it now makes sense now where this guy is saying that keg, therefore keg is not equal to Q and keg is greater than Q. This was what Modigliani Miller said. But is that correct? Let's check. Keg is 60%, right? Is not equal to Q, of course. Keg is greater than Q. 60% is greater than this. Can you see that now? So it's very correct. Let's solve another question. Are you feeling this class? All right, so it's not actually that hard. Just keep solving question, keep solving question. As I always say, that the reason why I'm doing this is just to help some people to get started, because getting started is actually difficult, right? And many of these things, they won't, or they may not even explain it in your class. And by the way, I'm not even an accounting student, right? Well, of course, I'm an ACA. It's not easy. So right now, I'm going to solve the last question. What I want to say is that, see, it's very, very important that you keep solving questions and you keep reading every day. If you are preparing to write any professional exam, be it November or May diet, please just ensure that you are reading every day. It could just even be 2 hours daily. Even if you are reading and you don't really understand it, shall make sure you are reading. Just stay consistent. Just keep reading, keep studying. And that's why I'm doing this for you people. That because some people don't even know how to get started, or some people have been reading ICAN Study Pack and it's looking like Jumong to them. They don't seem to understand. So that's the reason I'm doing this, to actually help some people get started, to show them some concepts or the reason why this is like this, or how to solve some questions. And as I've said regarding what SFM is, SFM, and the M is mastery. So keep solving questions, even if you feel right now when you get to the ICAN exam center, you will already familiarize yourself. Is that correct? Familiarize yourself. You will have familiarized yourself with how I can set questions and all of that. So all I'm trying to say is that. So all I'm trying to say, so I said all of that to say, keep solving questions, keep reading every day. It could just be 1 hour every day or 2 hours every day, but keep at it. It may seem you don't really understand. Watch these videos again and ask questions in the comment section. So we also have a WhatsApp group as well. So if you have any questions, ask me in my WhatsApp group, right? And I really wish you the best. So let's get started with the second question. So Royal Beverages Limited is an unlisted company considering a stock market listing. Okay. This I love. Okay, there's something I don't want to mention because when we get to risk adjusted cost of capital, you know, I'm going to say some things, right? So, since it intends to operate without debt financing, management wishes to estimate its ungeared cost of equity. The most comparable listed company is Prime Drinks PLC. Then we have the details. So Yarukayat said, determine the ungeared cost of equity of Royal Beverages. Same thing. So which formula we use? We use M&M. Keg is equal to Q plus bracket Q minus KD, value of debt, value of equity, 1 minus T. Simple. So we don't have, I thought to find this. So because we don't have this variable, we don't have this variable. So let's find it. So let's input our variables. So keg, what is keg? 80%. 18% is equal to, what is Q? Okay, we don't have Q, that's what we are looking for. Plus bracket Q minus, what is cost of debt? 10%. Value of debt 300 over 900 bracket 1 minus 0.25, because the tax is 20%. So let's solve for this first. So if you punch your calculator, 300 divided by 900 times 0.75. This is 0.25. 0.25 to bracket Q minus 10% plus Q 18%, right? So multiply through 80% equal to Q, like open the black bracket, 0.25 Q minus times 10, 2.5%. Can you see that now? So collect like times. So this would be 1.25 Q is equal to, when this one comes here, it would be 20.5%, right? Plus 18, 20.5%. So Q is what? Q divided by 1.25. Q is 16.4%. Can you see that? So simple. So does it meet what M and M were saying, is that keg is not equal to Q, and that keg is greater than Q? So keg is 80%, is not equal to Q, correct? And keg is greater than Q, 80% it is Q, so it's correct. Can you see that? Very, very simple. So the next class I'll be talking about debt. I'm going to also talk about the approach to determine the cost of debt, right? Are you ready? Don't forget to like, to subscribe, and to share with every other person that you think will need this, that you think this would be very helpful for any person, any student that is preparing for ICAN exam. Share this with them. It's completely free, right? Share it with them. All right, so I will see you in the next class. See you in the next class.